So in module 5, we are going to understand first. Is it recording? Okay. So in module 5, we are going to go and understand first that how carbon markets can combat the climate change and why we should know about it. And let me give you that story. Yeah, it's a kind of monologue which I'm going to give here for you to get the context. Every day nowadays, this is across world. Yeah, across world emit carbon dioxide, and they are the one who are driving the climate change. But what if we could make them to pay for their carbon emissions? The simple idea which I have just laid down has created a basis for carbon markets. If carbon has a price, businesses will have a reason to cut down on the pollution. This is exactly what carbon markets are designed to do. Reduce emissions by charging the polluters. However, these markets haven't been as effective as expected, and here is why. In late 1980s, the States faced an environmental crisis. The power plants were releasing massive amount of sulfur dioxide, causing acid rain that damaged the ecosystem and infrastructure. There was no financial incentive for these plants to stop polluting, which exactly what we see in our country for last 10 years. Now things are changing. But in 1990s, the US government introduced a solution after getting fed up and challenged by such kind of acid rains. That solution was a market called cap and trade that forced polluter to pay for their emissions. In 1998, emissions of sulfur dioxide has decreased by 20% in the affected region where they were facing such challenges, proving that this market-based approach could work. The success of this model led to an idea applying cap and trade principle to carbon dioxide emissions across world later. In 1997, the Kyoto Protocol encouraged the country to adopt similar strategies. So how does carbon market work? A government set a cap on how much carbon dioxide can be emitted by a specific industry, then divides this cap into permits for each of those companies which is operate in that particular industry. Companies receives these permits either for a free or by purchase and can trade them as needed going forward. If a company reduces its emission, it can sell a permit if it does not need it. If it need more, it can buy them from the market or from the others who has received similar permits. The beauty of this system is that it provides a dual incentive, the carrot, which we started discussing about yesterday, for innovation. Businesses are now motivated to develop a cleaner technology to cut emission and reduce the cost. And the stick, as emission decreases and cap tightens, cost of permit increases too, pushing the businesses to make even more progress. In theory, this could drive down the emission. At least that's what has been seen in past. But in practice, carbon prices have often been too low to make meaningful impact on global economy, as we have seen in the case of India and other developing countries. According to experts, the price of carbon need to be between $50 to $100 per tons of carbon dioxide equivalent by 2030 to meet the climate goals which we have set under Paris Agreement for becoming net zero by 2050. Unfortunately, the majority of the carbon prices still fall far below this target. Even carbon prices were raised, many penalty for exceeding the limits are simply too weak. In European Union, for example, fines can be as low as Euro 100 per excess ton of carbon emitted. which is only slightly higher than the cost of permit themselves. This isn't a much a deterrent, especially when the enforcement is laxed. However, this news is little old. Now, recently, Europe has imposed several other mechanisms to control this kind of laxity. Another challenge for carbon market, which we need to know is around world, is inconsistency of the pricing. Countries have different rule and regulation, and along with enforcement mechanism, forces this inconsistent to persist in the market. This leads to the carbon leakage in inverted comma, where the companies relocate to regions with a weaker environmental regulation to avoid paying for their emission. And that's why European Union has brought in CBAM as a new regulation. For carbon markets to work effectively, government must step to set and enforce the rules which require to make it our norm everybody adopts with the exact meaning of that carrot as well as the stick. They need to limit the number of available permits, drive up their price, set a minimum carbon price that increases over time and ensures that penalties for exceeding emission limits are serious enough to deter the non-compliance. This requires a strong regulation and commitment to tackling cheating and that carbon leakage. It's crucial that industry know the government is serious about enforcing this rule. In Europe, there is a progress in this area, and with regulator taking a harder stance on carbon market, making a lot of sense now. However, globally, many markets are still underdeveloped. To prevent carbon leakage, EU has proposed an additional law called carbon border tax, which I just summarized as a CBAM, carbon border adjustment mechanism, which would apply to goods and services which are produced outside in carbon intensive scenarios outside of European Union. This ensures that company can simply move production to country with a laxer regulation. However, they get penalized if they try to export to European Union. For carbon markets to be truly effective, we need a more integrated global system, which in COP29 has been discussed in detail. And with Article 6.2 of Paris Agreement 2015, which has been decided in COP21, coming into force may reduces this challenge furthermore. The challenges is especially significant with the major carbon emitters, specifically, and let me put up with a red border line, China. If China doesn't join the international effort to harmonize carbon pricing, the whole system could be undermined and the results remain, undue, subdued. But there is a hope. In recent year, European Union actions on reducing the number of permits allocates to pushing the carbon prices to 60 to 80 euros per ton, a record high in dollar terms. It is above 100 now. Yeah, other regions are started to follow the suit, and this is driving the momentum toward better carbon market. As carbon prices rises, greener industrial processes become more financially attractive and making it easier for company to innovate and decarbonize. With a stronger regulation, higher prices, and more coordinated action, carbon markets can finally fulfill their original goal, reducing emissions and combating the climate change. The world is at a crossroad. If a government continue to improve carbon markets, we can make real progress in the fight against climate change. This is a critical moment, and the future of our planet depends on how we navigate it. Thank you very much for listening this monologue. Now we will go into our proper workshop and taking you from the slides to slide. Thank you. Any question on the thought process which I have prepared for you before starting the class?